Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we're going to be taking a look at two oil service company stocks, and then I'm just going to talk about oil service company stocks in general, which is mostly the general view is what this video is going to be about. But I had a request for SLB, which I'm pretty sure used to be Schlumberger because that was the ticker of Schlumberger. And Baker Hughes. So I have requests up on my board there for both of these, and I thought I'd make a video where I just kind of explain my thoughts on those. I'm going to use fast graphs here to kind of show some of the price and earnings patterns. I do have a 25% off affiliate link down in the description if you're interested in trying out fast graphs. I think they have a free trial period too, so if you just want to test it and see if it's for you, you can do that. But definitely use that link down in the description if you want to give it a try. So with that, with SLB first. So I've owned this stock in the past, and it didn't work. I'll give you a spoiler. It did not work out very well. And I owned another oil service, a smaller oil service company as well. If we go back to what I was looking at back in the day, I bought this, I think it was late 2018 on this dip here. So what I was looking at there was this decline coming out of the energy price spike back in 2008 down to here. That was about 65%. They made a full earnings recovery and a full price recovery in the stock, and then they were experiencing another downturn. So my bet around here or so was that, it would probably recover over time in a similar manner that it recovered from the 2008 recession. That did not turn out to be the case, because really what this ended up being was, this was kind of a commodity cycle, I think, more than anything, that pushed the price and the stock price up before the Great Recession. And then when the demand for oil came down, that kind of reset that. And then what we had was like a fracking boom during this kind of time period here up through 2014, according to the earnings here, which created a lot of demand for like oil services and stuff like that. But that was eventually like basically a super cycle. So the world had tons of oil because frackers were, so I would say, like price insensitive for a few years, and eventually that ran its course. Well, Saudi Arabia lowered their oil prices long enough, and they started putting these frackers out of business that weren't making money, and that smashed the demand for all oil service stocks basically, and most oil stocks as well, down beyond what would be like a normal decline to like a super cyclical decline. And then when we had COVID hit, we had oil prices negative for a couple of days. And so we had even this bigger drop down. I don't remember exactly when I sold. I think it was before 2020. But I definitely took a loss on this. I took a big loss on my other one. And then I kind of went back in on the other oil service stock that I owned after Russia's invasion of Ukraine, somewhere around March. And then that fell to the one I took another loss on. SLB did a little bit better. It only fell like 25% and then recovered. But it's still, even people that bought there are basically like flat now. Like they haven't really made any money. So earnings look like they're coming back strong. I want to look at Baker Hughes too, because it doesn't look quite as rosy. I think SLB looks a little better. Yeah, so this is more what I was probably more typical here. They're a little weaker than SLB, so if I had to choose, if I really wanted to buy one, I had to choose one that would be SLB, because you can see in this case you have during the high commodity prices before the Great Recession, earnings peaked here. They never quite recovered. Again, the stock price peaked higher. Stock price never quite recovered. General overall trend during this whole time period has been down. So this is one I did avoid it even when I was buying these types of stocks. But really, right now, the bottom of the super cycle, I think, has definitely happened, and it looks like demand for oil services is I would call it normalizing, and so probably these stocks are priced correctly now for what everybody knows about the market. I think I like, and I've said this back in January when I bought Occidental and I bought Devon Energy. I like oil and exploration and production better in the mostly U.S. based for geopolitical reasons, to balance portfolio reasons in case there's like an energy price spike at some point. And I think that they were kind of reasonably priced as well. I just feel like that those businesses have a little bit more control over their own destiny than the oil services, which are just kind of another, like a step down, who they're going to kind of depend on the other oil companies to, need their services. So they're all going to move similarly, but well, maybe we'll take a look at Oxy. I mean, it should look, I don't actually remember exactly what this, oops, something bad happened, of course. Uh-oh. Let's see if we can reload anything. No, there, at least we got that one back. All right, so I guess we won't take a look at Oxy. There we go. All right, just had to be more persistent. So we can see in this case we have these sharp declines in earnings, but the earnings have kind of, well, they've definitely fully recovered there, but they've kind of fully recovered and leveled off. And oil's not super expensive right now. It's, like I said, this whole thing seems pretty in balance right now. So I think buying these stocks right now is more of a protection, defensive type of a thing at the portfolio level against an energy price spike, which could send a lot of other stocks lower because earnings and everything would be affected if energy prices were higher. So I think the reason to own these isn't so much like an offensive mindset where you're trying to get like a certain amount of return, but more of a defensive mindset that I could balance out some of the losses in a portfolio if there's an energy price spike that leads to an economic downturn. Like there's several steps there, but and if not, you're at least not like paying like too much for it. At least you're paying like a pretty fair price. So even during this 2018 bump, like for Oxy was 85. I want to say we bought it below 60, so there's some upside left there without anything crazy happening. And then if you look back, you can see it potentially getting to like $100 a share. So somewhere, there's still some solid upside, even if this just kind of floats up. But if we get a big spike, if we have an energy crisis of some sort, I feel like this stock reaction with the E&P companies will be better. The services companies just tend to have a lag. So it would need to be a persistent, I think, higher oil price spike. And the odds of that being persistent, I think, are low because I think the economy would probably roll over if it was persistent, similar to what it did in 2008. So that's my long explanation about why I'm just not really buying any oil services stocks. Even though I don't have anything necessarily, I don't think there's any doom and gloom on the horizon for them. They're probably doing most of them are okay. I just think like stocks like Oxy and Devon Energy are a little bit better. So hopefully that helps frame things, even though I didn't have like a bunch of numbers and like technical analysis or anything really. Just for me, it's just which one, if I'm going to buy it energy, where do I want to put my money? And these are like Occidental is where I would want to put my money. Okay, hopefully that helps. And if you found this useful at all, hit the subscribe button, hit the like button. If you have a request, let me know. I'll get the ticker up there and I'll make some kind of video. It might be a normal evaluation video, but it might just be one like this where I kind of just share my broad thoughts. And I'll see everybody later. Bye.